Hello, and welcome to the latest quarterly investment briefing from us here at Gemini Asset Management. It's been a really interesting quarter with much to intrigue investors, so let's dive in. In this briefing, we'll touch on the wild ride of global economies in the third quarter and market performance following this. So first, let's look at the global economic backdrop, which is where much of the focus has been in recent months. Markets have rolled and roiled, fallen and bounced, based on economic data released over the last quarter. The big news was the challenge of the previously held assumption that the US was going to manage to go through their interest rate hiking and cutting cycle, all without falling into a recession. Given the strength of the US economy, even with the US interest rates at multi-decade highs, investors were betting that the Federal Reserve was going to be able to pull off an absolute blinder and steer the economy through the inflationary spike and the economic turmoil of the last few years, also without avoiding that dreaded recession. Something which has substantially helped investor sentiment and equity markets over the last year. Chart 1, which is on screen now, shows how this picture changed over the last few months. A hard landing, shown here, is the scenario that would indicate a recession. And a soft landing, which is now shown here, is the scenario that would indicate the avoidance of a recession. As you can see, prior to August 2024, the markets had been pricing in a very high likelihood of the US avoiding recessions, which doesn't happen very often. Out of all the times that the Federal Reserve went through a rate hiking and rate cutting cycle in the last 70 years, only 4 out of 12 of them ended up in a soft landing. This increased likelihood of the recessionary hard landing between July 24 and August 24 then notably impacted markets for a short space of time, until sensibilities were then restored and markets steadied themselves, re-noting that even with the worsening economic data, the most likely outcome would still be that the US would avoid the recession, and the Federal Reserve would achieve its 5th soft landing. This brings us nicely onto market performance. Chart 2, which is on screen now, shows the performance of major regional equity markets since the start of the year. As you can see, so far, 2024 has been a rather strong year for equities in general, although it's not been without some notable sell-offs too. The US equity market continues to lead the way, posting positive returns of nearly 15.5%, still with 1 quarter of the year to go, which is some going. The UK has also had a strong year this year, which has been a pleasure, as the UK equity market has been hindered by poor sentiment over at least the last 5 or more years. This reassessment of the UK equity potential, mostly based on the notable cheapness versus global peers, has certainly been welcomed. During Q3 2024, you can see here on chart 2 that emerging market equities has also performed incredibly well towards the end of the period. This is after Chinese policymakers approved $500 billion worth of stimulus, which was designed to help drag the economy out of the doldrums and boost sentiment. As you can see by the end of the quarter performance, this was widely seen as being very positive for investors. However, not all was rosy in the last quarter. As we mentioned earlier, markets began to move away from the potential complacency surrounding the ideas of the US recession. And as you can see, during this final quarter, the US equity market and the Japanese market in particular fell considerably. But it then bounced equally spectacularly after investors regained confidence on that US economic outlook and put the base case back to being a soft landing. The reason for the bounce back wasn't just investors gaining clarity. It was also due to the reaction of various policymakers, most markedly the Federal Reserve in the US. Remember, central banks tend to increase interest rates to cool down inflation, something that we've all seen enough of in the last few years, but they also tend to decrease interest rates in the hope of fighting off any potential recessions and boosting economic growth. When markets began to worry about the US economy, the Federal Reserve was quick to act and then deployed rhetoric designed to help allay those fears, to indicate that they'd be cutting interest rates at the next opportunity. They certainly did that, and by a greater amount than the markets had originally been expecting. So the Federal Reserve cut interest rates by 0.5%, the largest cut we've seen from any major central bank in recent years. Chart 3, which is on screen now, shows the expected interest rate pathways for various major central banks around the world. You can see that even after the US Central Bank cut rates by 0.5% in September, the market is still betting that they'll cut by a further 2% in the next 12 months. You can see that there's a similar picture for the European Central Bank, and also a similar picture, if not a little bit less aggressive, here for the Bank of England. The rate cutting cycle has certainly begun, but some of these represent very high expectations for interest rate cuts, and compared to the start of the year, it really is a big difference. With rates being cut more aggressively over in the States, this can be viewed in many different ways, both from a positive and a negative point of view. But one thing's for certain, it led to a strong market reaction, and many investors are having to reassess their original assumptions that we discussed about earlier when we looked at chart 1. Here we continue to believe that the base case is for the US to avoid recessions, in the near term at least, and that's historically been positive for asset markets. But certainly we're not going to be complacent, and we'll continue to be anchored by the same principles that we've been anchored by whenever we've been constructing investment portfolios for clients. These principles are the principles of effective diversification, being proactive rather than reactive in times of market expectation changing, and ensuring that risk exposures are suitably monitored. Thank you for joining us for this investment briefing, and if you have any further questions at all, please don't hesitate to contact your financial advisor. Thank you.